Hello everyone, I welcome you back to this lesson, and here we'll be dealing with some low risk investment. All right, now shares is actually a risky investment. Why is it risky? Because you can actually buy a share for a specific price, and then the price will either go up or go down. Now let's assume I bought a share of like let's say 100 naira. I bought 10 pieces, which is about 1,000. Now if the shares go goes from the share price goes from 100 naira to 95 naira. All right. For each particular share, I've lost 5 naira, which is a total of 50 naira. Am I correct? Yes. A total of 50 naira for all my shares, for my 100, for my 10 pieces of shares that I bought. So I've lost 5%. So that's how it works. You can make profit and you can also make loss. All right. So but the idea is every company wants to grow, every company wants to make profit. So as they are struggling and trying to make profit, all right, they are in sync with what you want. Because as they are expanding, their share price is also increasing. So that's the idea. So sometimes it is quite unlikely for you to see a particular company facing a downward trend. A downward trend in the sense that the price of their share keeps going down and down and down unless there's a problem with the company, and it's going to be obvious because it's going to be in the news. But if there is not so much of a problem with a particular company, chances are excellent that their particular goal is to continue to expand. As established as the company Coca-Cola is, they still are looking for some certain level of expansion. All right. So every company wants to keep growing and growing and growing. And as they are growing, their share price is also increasing. So let's get down to some low risk investments. Compared to shares, this one are absolutely low risk. Well, let's just assume low risk, because the ones that are attached to the federal government, like the treasury bills, there's literally no way that the federal government will not pay. Of course they will pay back. All right, so let's get down into it. Let's explain each and every one of them one after the other. Bonds are long-term loans you give to the government or companies, and they pay you interest until they pay you back your money. All right, now when you hear loans, you start thinking 1 million, 10 million. No, bonds are actually divided. Like they are divided. I remember in 20, is it 2012 now? I can't remember exactly, but I think Goodluck Jonathan was the one on seat at that time. And I could remember watching an advert where the federal government was actually selling bonds. And one pieces of that bond is actually 10,000 naira. Yes. So the governments, all right, or companies will um sell bonds, all right. You will they will take your money. Let's assume they take your money 100,000 naira. They will give you a certain percentage, let's say 10%. 10%. What will happen is a stipulated time will be given. Let's say a period of 5 years. So the government will take your 100,000 naira for a period of 5 years, and then they will be paying you 10% of that 100,000 naira every year for the next 5 years. So that's the idea of bonds. So you see that it is actually a low risk investment, because first of all, the federal government have the capacity to repay you. So at the end of the 5 years, they will repay you. Actually, I didn't include that. At the end of the 5 years, they will repay you your 100,000, and every year till the 5 years, they will repay you 10% of that 100,000, which is 10,000. So they'll give you 10,000 for the next 5 years. 10,000 year one, 10,000 year two, 10,000 year three, 10,000 year four, and year five they will return your 100,000 to you. Is that okay? So that's the idea of bonds. Companies and governments actually have the right to actually sell bonds. All right. So they will pay you the interest yearly. It's not monthly. It's yearly. They'll be paying you the interest yearly, and then at the end of the stipulated time, it can be 2 years, it can be 1 year. At the end of the stipulated time, they will return your money for you. Is that okay? So let's look at treasury bills. Treasury bills are safe short investments where you lend money to the government and earn interest when they pay you back. Now, treasury bills are like what you do with your savings account. You put a particular amount of money in one of the saving app, and then they give you certain amount of return after the stipulated time is over. Let's assume you want to save your money for 1 year. But the beautiful thing about treasury bills is that the interest rate for treasury bills is actually high. I'm telling you, it's actually high compared to your savings account that you have in the bank. Yes. So that's why treasury bills is actually attractive. So most time you see, um, I think there was one I saw, was it 18%? 18%. And treasury bills are actually short term. Short term. I think from 3 months, yes, you can have 3 months, you can have 6 months, you can have 365 days. They are short term. They are short term, and their percentage is good compared to other kind of investment. Very, very good. One of um, the stuffs that gives you good assured percentage. There is no altering of percentage when it has to do with treasury bills. Like the percentage is fixed. You can't, it is not altered. All right. So the percentage of interest that you bought is the percentage of interest that you are going to receive. So this one is not like bonds that they'll be paying money every year, all right, or every month. No, bonds don't even pay every month. It's actually every year, please. So it is not like bonds. It is fixed. Once you give them your money, they don't give you anything until the time where you guys have agreed that you want to actually get your money back, and then they will give you your money with the interest. So that's how treasury bills actually works. All right. So you give the federal government 100,000, and then they say they will give you 18% interest rate, which is actually 18,000 after like 6 months. All right. At the end of that 6 months, they will return your 100,000 and the 18,000, which will be 118,000 naira. It's a low risk investment. You don't want to be bothered about anything. The thing is fixed. It's a low risk investment. All right. Now, the third one, commercial papers. They are short-term loans you give to companies and they pay you back with interest. I saw one commercial paper advert that Dangote company did quite recently, and the percentage is actually very attractive. All right. Now, the idea is like treasury bills, but treasury bills are for the government, while commercial papers are for companies, strictly for companies. All right. So they are literally the same thing, apart from the fact that treasury bills are for government and commercial papers are for companies. All right. They will collect your money, and after the stipulated period of time, they will return your money and the interest. So they are all short term investments, short-term investments. All right. Now let's look at an ETFs. ETF is like a basket of investment, stocks, bonds, etc. You can buy in one single trade. So you don't have to buy bonds separately, you don't have to buy stocks separately, you don't have to buy this separately, you don't have to buy different shares separately. You just simply have to buy an ETF. An ETF. And it's the ETF is actually an abbreviation for exchange traded funds. Is that okay? Now, I give you an example. The top 30 companies in Nigeria are combined to be one ETF. The top 30 companies. The advantage of buying an ETF and why it is a low risk investment is because if you have an ETF, all right, which is a combination of multiple companies, multiple assets in one particular um, basket of investment. If one, two, three, or five of the companies are not doing well, all right, what will happen is that the price of the ETF will not be affected so much. Is that okay? The price of the ETF will not be affected so much. So it will still be at a reasonable price. Now, if every of the company are doing well, the price of the ETF will increase. All right. So you, instead of one, two, three, buying shares in one, two, three, four, five, six, seven companies, buying an ETF is actually more, will I say more profit, not more profitable, but low risk. Because no matter how many companies are there, it will have to take a good percentage of the companies, like let's say well over 10, over 15, to actually be facing a downturn, all right, to actually be facing problem for it to affect the price of the ETF. So ETF is a low risk investment because the price hardly fluctuates because there are so many companies that are involved in these ETFs. All right. Another example is the S&P 500. It is the top 500 companies, all right, in the United States. Yes, the top 500 company, the Standard and Poor S&P 500, the top 500 companies in the United States. So let's assume 20 companies of those 500 companies are not doing well. It will not necessarily affect the price of the ETF. Even if it does, it will just be by a fraction. Is that okay? Good. So, and if all companies are actually doing well, or a majority of them are doing well, it will increase the price of the ETF. So this is actually safer compared to other kind of investments, because you can't tell me that 30 companies will be faulty at the same time. It's literally impossible. There has to be a couple of them that will be doing well, which will actually which will give rise or keep the stability of the price of the ETF. So it's a very, very low risk investment. So if you are somebody who doesn't like the drama that share price actually give, all right, the up and down, the volatility that is often found in buying of shares, these are certain low risk investment that you should consider. If you want the safety of your funds, like you don't want drama, you don't want share price has gone up today, it has come down today, it has gone up today, it has come down today. Of course, you see that drama in the stock exchange market. All right, but specifically, these are some of the things you should be focused on if you don't want drama, if you don't want um, any of the stuffs that shares actually gives. But the implication is that their return is fixed, most of them. All right, yes, most of them. The ETF, the return of ETF is not fixed. All right, but all these guys, their returns are fixed. You can't alter them, you can't change them. All right, so basically that's it. So consider some of these low risk investments if you want the safety of your funds. All right, so that's it for this class. I'll see you in the next class. For now, do have a beautiful day ahead. God bless you.